Welcome back, traders. This is your weekend market wrap, and what a week it's been. The market didn't explode, but it evolved quietly, deliberately, and with intent. Under the calm surface of the indices, we saw a week of recalibration. Macro pressure still humming in the background, rotation doing the heavy lifting, and traders playing the game with precision rather than emotion. Let's break it all down. What actually mattered, what the tape told us, and what this week revealed about real flow beneath the noise. Firstly, let's talk about index performance and tape structure. So I'm going to head over to this Reuters article for a conclusive summary. The S&P held positive, closing at 0.79% up. Nasdaq over 1% up after closing, and the Dow sitting at around 1% up. This week, we also saw some steady movement in futures, with the Nasdaq 100 future also gaining around 1%. And taking a look at the currencies, Euro to US dollar pretty much flat. Pound to US dollar closed just down at 0.14%, and the yen to the US dollar 0.21%. Lastly, the US 10-year yield also closing pretty much flat at 4,003. Underneath though, it was all about selectivity. The market isn't rewarding beta anymore, it's rewarding clarity. Money is flowing to businesses with margin resilience, clean balance sheets, and pricing power. Breadth again lagged. We had pockets of strength in semis, software, and energy, but plenty of single stock fatigue elsewhere. The tape told you the truth if you listened. Volume was light on green days, heavy on rebalances. It's institutions, not retail, that are steering the ship right now. So then, continuing to talk about macro levers driving the flow, this week was another masterclass in how macro keeps the pulse. What do I mean by that? Well, let's take a look at these yield figures again. Yields, the 10-year yield floated with that positive 4% range, and that range remains the invisible fence for risk. Every tick higher tightens liquidity in growth. Every dip invites rotation back into tech. Then, talking about the dollar, firmed slightly midweek as traders priced a softer Fed tone, weighing on commodities and inflows. Speaking of commodities, oil caught a steady bid off Middle East supply anxiety, while gold initially popped early in the week before retracing into Friday as yields rose again. Macro didn't break anything, it just reminded everyone who's boss. The equity story still dances to the rhythm of the bond market. Alright, traders, let's move on to sector rotation and institutional flow. And we're going to be talking about gold a hell of a lot. So let's talk about sector rotation and institutional flow. Sector rotation this week was the real story. You could see capital quietly rotates, not fleeing, simply rebalancing. Tech stayed bid, but leadership narrowed to AI infrastructure. Think chip equipment, data center names, and enterprise software. The speculative edges cooled off. Onto energy, continued to outperform, tracking crude strength and geopolitical premium. Defensives started to catch rotation inflows, especially healthcare and staples. A classic sign that smart money is building cushions, not chasing tapes. And financials traded flat overall, but regionals held their own, suggesting credit fears are no longer the overhang they once were. That flow tells you exactly where the big books are repositioning, out of high beta into balance sheet clarity and real cash flows. Next, let's talk about lessons from the week in this tape. This week rewarded those who could read flow, not chase headlines. Gold rewarded early buyers as the safety bid built, but the late chasers got faded, and the news this weekend is pretty much dominated by gold and the bond yields. Oil remained the macro hedge trade of choice, and AI infrastructure stayed hot, but only the names with scale and earnings power, not the narratives. The losers, anything speculative without cash flow, those names got systematically de-risked. That's the new market character. Every rally is being measured. Every dip is being bought selectively. No one's swinging, everyone's scaling. Now let's talk a little bit about the market's character shift. A lot of trading is related to psychology, as I'm sure you're well aware. The psychology of the tape changed again this week. This isn't a momentum market anymore, it's a positioning market. You can see the behavioral shift. volume thinning out, option flow flattening, realized volume compressing. That's traders conserving energy, waiting for macro clarity and playing defense when needed. It's not fear, it's strategy, and that's healthy. The market's maturing into its next phase, not melting up or breaking down. Let's talk a bit about the big picture then. What are our takeaways? Well, what did this week really teach us in essence? Yields still control sentiments. Forget Fed talk. The 10-year is the real storyteller, and let's not forget it. Breadth matters. Rallies without participation die young and usually pretty fast too. Rotation isn't weakness. It's the heartbeat of a functioning market. And lastly, discipline greater than prediction. This week, traders who sat on their hands often outperformed those who tried to front run the next move. The tape this week wasn't dramatic, it was deliberate. And that's exactly how real trends form. Alright traders, in closing then today, let's wrap it up. That's your wrap for this week. Essentially, we saw quiet volatility, disciplined flow, and a market slowly rewriting its own rhythm. The best traders this week didn't chase, they watched, adjusted, and executed with patience. Enjoy your weekend, reset the charts, and come back clear on Monday. We'll be here before the bell to set the tone for the new week. That's your wrap. Stay sharp, stay focused. I'm going to bring you more trade setups next week, and I hope you found this useful as always. If you did, drop us a comment. Thank you for taking the time, and I'll see you before the bell on Monday. All the best.